What if I told you the silver market didn't break in New York? It didn't break in London, and it didn't break during a press conference or a headline-driven panic. It broke overnight, quietly, in Asia. For decades, we were taught a very clean and comforting story. That price discovery lives in the West, that New York decides the price, that London clears the trades, and that Asia simply follows along afterward. That story just collapsed. While Western desks were closed, while analysts were asleep and banks were offline, silver pushed through $72 in Asia. There was no drama and no hype. There were no viral headlines or emergency interviews. There were simply buyers showing up and paying more. That detail matters more than anything else because paper silver can be created instantly, but physical silver cannot. What happened overnight was not speculation chasing momentum. It was metal changing hands, and when metal starts moving, control starts slipping. For years, Western banks have managed the silver market through paper systems. Futures contracts, liquidity walls, and short-term price smashes were used to reset sentiment whenever things became uncomfortable. As long as most demand stayed financial instead of physical, this system worked. Paper is easy to create, easy to sell, and easy to control. But Asia does not treat silver as a financial idea. Asia treats silver as inventory. When buyers in Asia are willing to pay up immediately without waiting for confirmation from New York or London, it signals something very specific. It means supply is tight, it means timing matters, and it means the metal is needed now, not later. At that point, price becomes secondary to availability, and that is when the rules change. Western banks did not lose control because silver went higher. They lost control because their tools stopped working. The price did not spike and fade. It was not slammed back down at the open. It broke, held, and settled quietly. There were no emergency statements and no official explanations. There was simply a higher physical clearing price, established where real demand exists. By the time Western markets opened, the damage was already done. Once Asia establishes a higher physical reference point, the West does not get a vote. It has to respond. And responding is dangerous when your system is built on promises instead of bars. Futures contracts can be rolled, narratives can be rewritten, but physical shortages cannot be explained away. This was not supposed to happen this way. Not this early, not this cleanly, and certainly not this quietly. But it did. And when control breaks in the physical market, it does not return through speeches, forecasts, or temporary paper smashes. It only returns if real supply shows up. That is the problem. Supply is not showing up. And in the next part, we need to talk about why paper silver failed the exact moment physical demand stepped in, and why this breakdown did not begin last night. It started much earlier. To understand why last night mattered, you have to understand how silver has been controlled for years. The Western system is built on paper dominance. Futures contracts trade in volumes that dwarf the amount of real metal that actually exists. On paper, silver looks abundant, infinite even. Contracts can be created, rolled forward, and settled without a single ounce ever moving. As long as most participants are trading exposure instead of inventory, the system appears stable. But that stability depends on one fragile assumption: that physical demand stays passive. As long as buyers are content to hold paper claims, banks can manage price. They can cap rallies, absorb demand, and use volatility to shake out weak hands. Paper is flexible. It bends. It absorbs pressure. Physical metal does not. It either exists where you need it, or it doesn't. Asia exposed that difference. When physical buyers step in, the market stops behaving like a chart and starts behaving like a supply chain. Futures prices no longer matter if the metal cannot be delivered on time. Hedging becomes irrelevant if inventory is unavailable. At that point, the question is no longer what is the price, but where is the metal? That's when paper breaks. The overnight move above $72 was not driven by leverage. It was driven by availability. Buyers were not chasing momentum. They were securing supply. And that distinction is everything, because banks cannot print inventory. They can only promise it. Western banks rely on the assumption that most contracts will never stand for delivery. That assumption allows them to control price through scale. But when physical demand rises, scale becomes a liability. Every additional paper contract represents a promise that may have to be honored with something real. And something real is exactly what's running thin. This is why traditional tools failed. Margin hikes don't stop a buyer who needs metal. Volatility doesn't scare an industrial user who cannot afford a supply disruption. And paper selling does nothing if the bars are already spoken for. Once physical demand asserts itself, paper loses its authority. What happened in Asia was not an attack on the paper market. It was something more dangerous. It was indifference. Buyers did not care what futures were doing in the West. They paid the price required to secure supply and moved on. That behavior bypasses the entire control mechanism. And when control mechanisms are bypassed instead of challenged, they become irrelevant. This is why the West could not simply reverse the move. There was nothing to smash, no excess leverage to flush out, no speculative frenzy to cool off. The price held because the metal was needed. By the time Western desks opened, the narrative had already lost credibility. The market had cleared at a higher level somewhere else. And once that happens, the West is forced into a defensive position, trying to explain why its price no longer reflects reality. That's a dangerous place to be, because confidence in paper pricing depends on the belief that paper and physical are interchangeable. The moment that belief breaks, the market enters a different phase. A phase where delivery matters more than liquidity and inventory matters more than sentiment. And that is exactly the phase silver just entered. In the next part, we need to talk about why Western banks were uniquely vulnerable at this moment and why this loss of control didn't come out of nowhere. It was set up years in advance. To understand why Western banks lost control so quickly, you have to look at their weakest assumption. For years, the system worked because banks believed physical demand could always be delayed, that buyers would accept paper settlement, that inventories would stay good enough, and that any shortage could be managed with price suppression and time. That assumption is now broken. Western banks built their silver strategy around scale. They assumed that by controlling enough paper volume, they could dictate price regardless of what was happening underneath. And for a long time, that was true. Most contracts never asked for delivery. Most traders just wanted exposure. The system didn't need metal, it needed confidence. But confidence depends on silence. The moment physical demand starts speaking louder than paper volume, the balance shifts. And that is exactly what happened. Asian buyers didn't wait for price confirmation from New York. They didn't wait for liquidity to return. They moved first because they had to. When you're securing supply for manufacturing or strategic reserves, waiting is not an option. That caught Western banks in the worst possible position. They were heavily exposed on paper but lightly positioned in physical. That imbalance doesn't matter when delivery is rare. It becomes fatal when delivery is demanded. Suddenly, every short position is not just a trade, but a promise. And promises are dangerous when inventory is tight. This is why the usual defenses failed. Selling more paper did not push the price back down in Asia. It only widened the disconnect. Raising volatility did not scare buyers away. It made them move faster. The more unstable paper prices became, the more urgent physical demand grew. Banks were no longer fighting speculators. They were fighting supply constraints, and supply constraints do not negotiate. By the time Western desks opened, the narrative had already slipped out of their hands. The market had cleared at a higher level elsewhere. Trying to force price back down would have required dumping even more paper into a market that was already questioning its legitimacy. That is how confidence collapses. So instead of control, banks chose containment. They let the price hold. They avoided dramatic intervention. They tried to downplay the move, because a loud defense would have drawn attention to the one thing they cannot afford to highlight: the growing gap between paper claims and physical availability. This is not panic yet. It is something more controlled and more dangerous. It is quiet repositioning. Banks are not admitting defeat. They are adjusting to the reality that control is no longer absolute, that price can now be set somewhere they do not dominate. And that is a structural problem, not a temporary one. Because once the market learns that physical silver can clear higher without Western approval, expectations change. Buyers stop trusting dips. Sellers stop trusting caps. And the entire pricing mechanism becomes unstable. This is how control is lost in modern markets. Not through collapse, but through irrelevance. And in the next part, we need to talk about what happens after control slips, how this changes behavior, why volatility increases, and why the next move is rarely small. Once control slips, the market doesn't collapse immediately. That's the mistake most people make when they look for signs of failure. They expect chaos. They expect headlines. They expect something dramatic. But in reality, the most dangerous phase comes after the initial break, when the system pretends everything is still normal. This is the adjustment phase. In this phase, behavior changes quietly. Buyers stop waiting for pullbacks. Sellers become reluctant to offer metal at fixed prices. Dealers widen spreads, not because they want to, but because they have to. Inventory becomes more valuable than liquidity, and price starts moving in steps instead of waves. This is exactly what happens when control shifts from paper to physical. Paper markets are designed for speed. They thrive on volume, leverage, and rapid turnover. Physical markets move differently. They respond to availability, logistics, and trust. When physical begins to dominate, volatility doesn't disappear. It changes character. Moves become sharper. Gaps appear. Prices jump without warning and refuse to retrace. This is why the first sign of lost control is not a crash or a spike. It is unpredictability. Western banks understand this. They know that once physical demand leads, their influence becomes reactive. They can still manage headlines. They can still influence sentiment, but they can no longer guarantee outcomes. So the strategy shifts. Instead of forcing price back down, banks focus on slowing the pace. They allow higher levels to hold, but try to prevent acceleration. They attempt to stretch the timeline, hoping that supply will reappear or demand will cool. Time becomes the last remaining tool, but time works against them. As prices hold higher, More participants start questioning the old reference points. If silver can clear at higher prices in Asia without stress, then the old fair value narratives lose credibility. That's when sideline demand begins to step in. Not all at once, but steadily. This creates a feedback loop. Higher prices validate physical demand. Physical demand tightens supply. Tight supply reinforces higher prices. And every attempt to suppress the move increases suspicion instead of restoring confidence. This is why post-control markets are unstable even when they look calm. Nothing breaks publicly. Instead, trust erodes privately, and markets driven by eroding trust behave very differently from markets driven by fear. Fear causes sharp moves and quick reversals. Distrust causes persistent trends. We are now in that transition. Silver is no longer just responding to economic data or interest rate expectations. It is responding to availability, logistics, and strategic behavior. These are slower forces, but they are harder to reverse. And once participants realize that price is no longer fully controlled, they change how they interact with the market. They stop assuming intervention will always succeed. They stop assuming dips are safe. They start assuming supply matters. That shift is subtle, but it is powerful, because markets don't need panic to move higher. They only need doubt. And in the final part, we need to talk about where this leads, why this phase rarely resolves quietly, and what happens when the market finally acknowledges that control is no longer centralized. Markets almost never resolve transitions like this in a calm, orderly way. When control shifts, when price discovery migrates, and when trust in the old mechanism erodes, the final outcome is rarely a smooth adjustment. It usually comes through compression, not collapse. Pressure builds quietly until something gives. That pressure is building now. As physical demand leads and paper influence weakens, participants begin to operate on different assumptions. Buyers stop expecting quick pullbacks. Sellers stop trusting that intervention will always cap prices. Dealers become cautious, not because demand disappears, but because supply is harder to replace. Each of these changes seems small on its own. Together, they reshape the market. This is how liquidity thins without anyone announcing it. In this phase, markets don't move because of headlines. They move because participants act defensively. Inventory is held back. Orders are staggered. Offers disappear without warning. When price moves, it jumps to where the next real offer exists, not where a chart says it should be. That's why gaps become more common. Western banks understand the risk here. They know that once price is driven by availability instead of leverage, traditional controls lose precision. Interventions become blunt. Every attempt to suppress price risks, revealing scarcity. Every failed attempt damages credibility. So banks delay, they manage optics, they avoid dramatic action, and they hope the system stabilizes on its own. But stabilization requires supply. If supply does not return, the market has only two options: repricing or rationing. Repricing raises prices to levels that reduce demand or attract new supply. Rationing restricts access, widens premiums, and creates parallel markets. Neither outcome restores the old structure. This is why quiet phases like this are deceptive. On the surface, price may move sideways. Headlines may calm down. Analysts may declare the danger over, but underneath, behavior has already changed. And markets driven by changed behavior rarely go back to previous norms. The most important shift is psychological. Once participants realize that control is no longer centralized, they stop relying on promises. They start relying on possession. That changes how value is measured. Paper claims lose their advantage. Physical ownership gains relevance, and the market begins to price risk differently. This is not a prediction. It's a pattern. We've seen it before in other markets at other times. The early signals are always the same: quiet repricing, widening gaps, cautious dealers, and increasing emphasis on delivery. The final outcome varies, but the path is familiar. Silver is now on that path. What happens next doesn't depend on sentiment or forecasts. It depends on whether supply can reassert itself quickly enough to restore confidence. If it cannot, the market will continue to adjust. Not violently at first, but persistently. And persistent moves are the hardest to fight. In the final part, we need to bring this together. What this means going forward, why the next phase often surprises even experienced participants, and why markets rarely give clear warnings before the last adjustment happens. This is the part of the cycle most people misunderstand. They think the danger is already over because the first shock has passed. The price didn't explode, the system didn't collapse. Headlines moved on, and that creates a false sense of safety. But the most important damage has already been done. Control doesn't need to vanish completely to lose its power. It only needs to become unreliable. Once participants realize that price can clear somewhere else, that delivery matters more than paper settlement, and that intervention is no longer guaranteed, behavior changes permanently. That change is irreversible. From this point forward, every move carries more weight. Every dip is questioned. Every rally is treated as confirmation instead of noise. The market becomes less forgiving, not because people are emotional, but because trust has been weakened. This is when volatility becomes asymmetric. Moves higher travel farther than expected. Moves lower are shorter and quickly absorbed. Not because of optimism, but because availability matters more than sentiment. When physical markets lead, the price doesn't need excitement to move. It only needs demand to remain steady. And steady demand is exactly what creates pressure. Western banks may still influence the pace. They may still manage optics. They may still delay the outcome. But delay is not control. It is time bought at a cost. And time only helps if supply returns. If it doesn't, the market will continue to adjust quietly, step by step, until the old reference points no longer make sense. At that point, the reprice won't feel sudden. It will feel inevitable. That's how these transitions end, not with panic, with acceptance. And by the time acceptance arrives, the opportunity to react has already passed. This didn't happen overnight, but last night confirmed it. Control didn't slip loudly, it slipped quietly. And quiet shifts are the ones that change markets for years.